Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be Michael Becker, but today we have Ricardo Hinojosa.
How's it going, Paul?
We're going great. Ricardo, thanks for being in the podcast today. Michael is out doing some initial due diligence on a property that group is looking to buy right now. So he is busy and under the hood looking to figure out if it's the right property for that group to buy. So in the podcast today, we're excited to have Mike Spotts in the podcast. And Mike has just closed on a 94-unit apartment building over in Irving, Texas. And I thought we would kind of get Mike's opinion about how he did it, how he's managing it, how long it took for him to find it, and kind of see how he did it. So welcome to the podcast, Mike Spotts.
Hey, Paul. Thanks for having me.
Thanks for coming in. We appreciate that. So tell us a little bit about Mike Spotts. I mean, what's your background?
So a little about me. Grew up in Plano. Went to college down at Texas State. And then when I came back from college, started my career.
Okay.
First started designing telephone switching equipment there in Plano. Did that for a couple years. Then went on into aerospace. Worked for ComSat, which is a division of Lockheed Martin. I designed satellite tracking equipment for half a dozen years and really enjoyed it, but got a little bit bored of it, honestly.
Really?
Yeah, I mean, it was great designing and everything, but need a little something more.
So, real estate.
Mm-hmm.
When did that start? I know you've got a little bit of a background before multifamily. How'd you get started in real estate?
I do. When I got out of college, I moved back to the area and bought a duplex and lived in one side, rented out the other. And I went, wow, this is great. Somebody's paying my mortgage. So over the next couple of years, I bought a couple other properties and then really went off to my career for a few years.
Yeah. You developed quite a portfolio there. We've talked about this a few times. But
Sure.
You ended up with how many single-family units?
13. 13.
Not bad.
So not too bad. When my W-2 job ended, about when the economy took a slip and the housing bubble burst, back in 2008, started buying up properties and just started getting my education, buying them, rehabbing them, and getting going in it.
Excellent.
And really, really enjoyed it.
So where were the 13 properties located at? In and around your house?
Yeah, I live in Plano, so I kind of kept them real close. They were in Plano, Frisco, Allen, McKinney, and Denton.
So huge growth areas.
Yes, wonderful time.
Give me an example of one property, not your best one, not your worst one, but
middle of the road.
What you bought it for, what you sold it for.
Yeah. So here's a middle of the road one. Several of them are in this kind of area. Bought it for $150, 2,000 square foot house, Plano. Light rehab because it really didn't need much. A lot of them just got foreclosed on, so they were really in pretty good condition. So do some light rehab. Back in that time, still, the rental market is absolutely phenomenal. So you could buy these assets, do a little bit of light fixing up, get renters in real quick, good qualified renters. They would stay for years. So bought it for $150. This one held on to it for maybe 4.5 years. Sold it for $330.
Wow.
Outstanding.
Yeah. As a matter of fact, I close on another one this afternoon. So
we'll make this podcast quick so you can start counting your money even faster.
So you came to us, you had acquired your single families.
You did.
And we all met when you were wanting to transition into multifamily. So your game plan was to, hey, how do I pull this equity out of single family and get into multifamily? So talk to us a little bit about why multifamily. I mean, you've been successful in the single family business. You did real well. What attracted you initially to multifamily?
So honestly, I think it's the progression. It's the next step. I did really well. Like you say, I think I did really well with the single families, but there becomes a saturation point that I think it's time to move to the next. Yeah. So I joined a mentoring club and started getting an education. And then I sat down with Paul Peebles, and he actually said, your net worth looks good, but you have no liquidity.
Yeah.
So that's when I started selling off my properties.
Yeah, because most of your liquidity was in hard assets.
It was, yeah.
Yeah, so just like the guy who owns a jewelry store, that guy has all of his hard assets in jewelry in the front window. So if any time that he ever needed to raise liquidity, he'd have to go and sell a Rolex. And that's what Mike had to do, is he had to sell property to raise his liquidity level.
So that's a pretty big leap, right? In making the decision, hey, I've got these cash flowing properties, I've got a ton of equity. For you to have the vision to, I need to scale, I want to grow my business. But a lot of people aren't willing to make that leap. I guess what gave you the confidence that was the right way to go?
Yeah, I honestly, for years, I've known that's the direction I wanted to go. Yeah. And you're absolutely right. It was a leap of faith. Yeah. A lot of these properties are paid off. I'm cash flowing. My rents are about 21 grand a month. Yeah. So I had great cash flow. I didn't need to start selling these and move on. But I knew at the end of the day, this is what I wanted to do. I wanted to get into the multifamily side of it. So making the move was fairly easy for me because I decided that years ago. Mm-hmm. And then after you get the education, it becomes clear. It does become a lot easier to palate.
Yeah. So talk a little more about the education process. This started
So it started in December 2015. A friend of mine called me and said, hey, I'm going to an investor club, and asked me if I'd like to go. And I said, oh, yeah, I've been listening to them for years. I'd love to. So we went to the meeting. I signed up immediately and then just started getting my education and just ran down that road. And December 2015 and started selling the properties after this and started building a team.
A team is such an important point
It's huge,
in the commercial real estate and multifamily business. Is that, I would think that you could probably do it yourself, but it could take a lot longer and you could make a lot more critical mistakes. And when you make critical mistakes in multifamily or commercial real estate, the numbers are a lot larger. So $40, $50, $60, $100,000 mistake is a big number. Buying a property in the wrong area is a big problem. So having a mentor and an education group or having team members to kind of help you and work with you is so critical.
It really is. And I'm a broker as well. So going through all these single family homes, I actually looked at a couple different apartment complexes, small properties, but I could never make it work. I just didn't understand the numbers well enough. And thank goodness I never pulled the trigger on anything.
So next steps, you get educated, you start building your team, you sit down with Paul, kind of build a roadmap to, hey, here's the end goal, and here are the steps to get there.
Sure.
So you started selling off your properties. Now it's time to look for a multifamily asset. So talk to us about your strategy there. Where you jumped to a pretty sizable 94 unit deal, but was that the game plan going in? Or how did you get to that point?
Sure. Originally, because of economies of scale, my target was always 100 to 150 units. Mm-hmm. And that was kind of the first that was in my box. I knew what I could afford. And with the team that I had surrounding me, this is what the target was. So after I got the education, we started looking for properties, and I traveled all over. I didn't care where it was, looked everywhere in Texas. Primaries, secondaries, tertiaries, Texarkana, Wichita Falls, Austin, San Antonio, everywhere. Yeah. And then finally, all of a sudden, this one came up. Chris, got an email from Chris from CBRE one morning, called him, set up a tour, and met with him, walked the tour, sent him an LOI that night. And luckily that happened.
Before you got to that position, did you make some passive investments into some multifamily properties too?
I did, yeah. There's a couple gentlemen out in middle central Texas. And I joined in a couple of the passive programs or the properties that were down there.
And so what was good about that is that you learned a little bit from watching how those guys put the deals together?
It definitely is, yeah. They sent out the PPMs. You go through the numbers and you really start learning. A lot of the education is going through it a couple times. Book learning is okay, but until you invest in a property, that's when you start seeing the real numbers. You walk the property, you run through the numbers. And that's when you start getting your education.
And Ricardo, what is a PPM again?
It's a private placement memorandum. It's basically your offering. So the investment offering, you put together the business plan. It's a legal document that basically advertises your investment to investors. And that's what they use to kind of read through it and make their investment decision whether or not they want to invest with you. So
Again, how many did you get into? And
I was in 2. I'm in 3 passive deals now.
Okay.
But before I got my property, I was in 2.
And so you got to kind of figure out what you liked about those partnerships. You got to understand about what type of information they were pushing out to you.
Correct, yeah.
You got to read. Do they send out quarterly or do they send out monthly reports to you guys? Do you remember?
At the onset, it was a little slim.
Yeah.
Maybe one time in 6 months.
Of a report?
Yeah.
On how the property's doing?
Yeah.
Hey,
It was pretty light. Unfortunately, it was really light.
yeah.
So you didn't like that because
I didn't like that. Correct.
as an investor, you
As an
didn't.
investor, I want to know. I want to know what's going on a monthly basis at least.
So you also learn what not to do, what
exactly.
to do and what not to do.
I did learn that.
So that was one of those things. What, what not to do.
What, check what not to do.
So in this process, you're investing with others, you're building your team, because you didn't buy this deal on your own, right?
Oh, no.
Agave Villas is the name
Correct,
of the property
yeah.
that you
Yeah.
purchased. Talk a little bit about your team. You had how many KPs or key principals?
So I had 2 KPs. Well, it was a couple, Bethany and Gregor. So they were 1, and then Steve. And you just need your team. So with those 2 folks, we were able to basically close the deal. And then with passive investors, we had about 30 investors.
So as my analogy goes, so you had 30 people in the back of the airplane.
There you go.
You had Steve and Bethany and Gregor, who were your first officers, co-pilots.
I'm sorry, it was John, not Steve.
John.
John Steve.
John and Bethany and Gregor
Correct.
were your co-pilots in the deal, and you were the managing member or / the captain of the airplane. So how long did it take you to put that team together?
Oh, surprisingly, it was pretty quick. Once we identified the asset, we had a meeting, and we were able to get fully funded within about 36 hours. It happened really quick.
Amazing. So let's kind of break into the property itself. Again, we're trying to teach you in this one, how did you get there? And so let's talk a little bit about the property.
Yep. So you connected with a broker, Chris Douillet at CBRE, kind of brought it to you. What'd you like about the deal? So the deal is Agave Villas. It's in Irving, Texas.
Great location.
94 units.
Yeah.
So location was the biggest thing for you.
Location was incredible. I really liked the submarket. The location's great. The previous owner bought the property. It did quite a bit of work on starting to rehab it, and that's what he does. Grabbed the asset, it was 79, 80s vintage asset in fairly good shape, and we really liked it. We went through due diligence. We looked at the roofs, the foundation, the plumbing. We walked every unit.
Who did your physical due diligence? Was it the property management company, or did you hire a third party?
We did.
company?
Yeah, Allied actually did the due diligence.
Okay, so it was another third.
It was a third party. Yeah, correct.
So a third party. So it wasn't you and a bunch of guys.
No. Hire the professionals.
That's right.
Hire
Hire
part of your team.
Right. Hire an electrician. Hire
Correct.
Somebody that knows what roofs should look like, and plumbing, and scope the pipe. Did you guys scope the
We
pipes?
did, and we very happy.
Any surprises on that one?
Yeah. Well, luckily, because of the age of the asset, it was all PVC.
Great.
But when we were scoping, we found a large flow of fresh water. Yeah, I know. Funny here. We found a 3/4 inch incoming water line severed. So it was a lot of water being flowed out.
And this was flowing as you guys were
We
doing
were
the
scoping
inspection.
it, yeah. And we just got lucky. In the building that we were scoping, the gentleman who was scoping it heard it coming through the plumbing, and investigated it and saw a large flow. And we were able to get that fixed before we closed.
Excellent.
Yeah. And you could see it when you look at the water bills. They were using 1 million gallons a month. And it was about $100,000 or 100,000 gallons more than they should have been.
Wow. So water is money.
Water's
and
a lot of
money
money.
was flowing down the toilet
Right down there,
to the plumbing lines.
So you like the deal, you like the location. It's a very good Central Irving location. You've got a lot of retail, you've got a school across the street, an elementary school right across the street.
High school.
High school.
Yeah,
Okay.
correct.
High school right across the street. You get residential all around you. So very good central Irving location. So that was a big plus. The current ownership group, you said, had done some renovations. I think they've done a lot of the exterior heavy lifting, right?
The heavy lifting, yeah. The exteriors.
So the roof was in good shape.
The roof was replaced about 2.5, 3 years ago. Great shape.
Yep.
All but one building, but that was still in good shape. They did exterior painting.
The siding, I think, was
Some of the
was done,
siding, yeah. They resurfaced the driveways, repainted, restriped. But overall, looked really well.
So the property looked good. It showed really well.
Showed
I remember
great.
getting to the property and just saying, wow, this is a nice looking property.
Yeah.
So talk about your strategy. Where'd you see the upside? Where are the opportunities for you kind of going forward?
So for us, when we looked at the asset, we saw what the previous owner was doing some upgrades, rehabbing the inside, and tested out a couple things, backsplash, granite, stuff
Yep.
like that. I'm a strong supporter of that. So looking at the asset, we really thought we could continue with that. Doing privacy fences. On the back side of the property, about 24 units are more like townhomes. So they're a little bit bigger, and the ones on the first floor, we're planning on putting fences there, privacy fences. So that's another revenue stream for us. So we can do some of those upgrades, interior upgrades, doing the vinyl plank, just kind of really sprucing it up. So far, it's been great. We've been able to turn a few of the units, done granite in them, and it's really turning out well. One of our biggest issues is we're not able to turn enough.
Because you're full.
We're
You're
full.
right? Yeah.
We're 100%. It's a good problem to have.
Good problem to have.
But it's eventually we're just going to have to turn these units.
Yeah.
But our goal was to do it within 12 to 14 months.
Okay.
I think it's going to take a little bit longer than that. But again, a good problem.
Good problem to have.
Yeah.
Very good problem. So
Yeah.
talk about the rent bumps that you're seeing. Can you give us a little feel for
Sure.
what are you getting on the improvements?
So on the typical improvements, we're even without any of the improvements, we're seeing about $75 to $100
Okay.
without any upgrades. With the upgraded, we're seeing about $125. We're doing granite. We're able to get anywhere from 40 to 60. So roughly
Over and above.
50, over and above.
Yeah.
Absolutely. So we're seeing great support for the granite, the backsplash, and all the upgrades. So the goal is to continue down with the granite and see what the market will bear.
Yeah.
I mean, it's
Just take it as far as you can go.
take
Yeah.
this. We're getting great prices. We have a great new granite company, and they're doing a great job. So once we get in there, turn the units, it's turning out well.
Now, your background before, I know it's helped you quite a bit, specifically with the rehabs.
Oh yeah,
All of your
quite a bit.
talk a little bit about how that's helped you with the comfort level in rehab, knowing what to rehab, what not to rehab.
Sure. Well, as I was buying up a lot of these properties, the single family properties, target was always to try something new. Every time I bought a property, I would try something new. So basically, I would look at tearing down a wall, tearing down bathroom, who knows, kitchens, just tear it up and rebuild it. And that gave me the comfort level to where I go through a property now and I know what it costs. The benefit of all these properties I've had in the past is I learned the cost structure, what it costs to do the rehabs. I know how to do it myself, and I know the costs. And not only that, I know how to do the HVAC myself as well, electric, plumbing.
Now, you don't do it yourself, though, right?
I don't need to.
Yeah.
But the benefit is I know the cost.
Exactly.
And that's what I learned over the years, what it costs to do things.
Did you ever take a CAMS or CAPS class?
Not yet, but I will. I do have my HVAC license.
No kidding.
Yeah. Well, as I was going through these properties, I found out one of the largest costs of going through the rehab, renting these properties out. It was thousands of dollars a year in HVAC costs. It's Texas. It's hot.
Yeah.
So you get a lot of problems. So I took 2 weeks. I went and got my license. And 90% of the problems can be fixed with less than $25.
That's great.
I just saved a ton of money.
So, Ricardo, what are CAMS and CAPS classes?
Yeah, so these are educational, ongoing educational courses that you can take, usually put by the National Apartment Association. And the CAM Certified Apartment Manager is an apartment manager certification that you can take. CAPS is apartment portfolio supervisor.
Correct,
So that's more for either asset managers or regional manager type of roles. they're essentially continuing education and certification.
Yeah, it certainly helps people who have never been in this industry before.
Yes.
Just like what Mike was saying, because you can be taken advantage of by somebody that comes in that kind of tells you what it should be. And once you get a level of knowledge, you're telling them what it really should be, not them telling you how it is.
Makes a difference.
It certainly makes a difference. And so now what I like about Mike is that he knows so much, is that probably more than his property manager, unfortunately,
Yes.
on a square foot basis of what flooring costs or what brushed nickel appliances cost. And he has now sources that he can get that stuff cheaper than a lot of the management companies can. So I definitely like somebody that puts time into educating themselves about where the best sources or vendors or how not to get taken advantage of. Would you agree with that, Mike, at all?
I definitely agree with that. It has made all the difference in the world. Even though my third-party management they're great, and we've worked well together with the sources.
Yeah.
I mean, we've been able to reduce a lot of our turn costs just because of the vendors they have and the vendors that I've brought in, as well as my mentor group. So yeah, education makes all the difference.
So let's talk about, we closed on this deal. You closed on this deal when
February 6th.
So not too long ago.
Nope.
So let's talk about the debt piece of it. So we ended up going with Fannie Mae. Yep. So it's Fannie Mae non-recourse debt.
Yep.
And how the heck did you get Fannie Mae non-recourse
First timer.
debt?
How does that happen?
Yeah, how does that happen?
I have friends in high places. Paul Peebles, thank you very much.
It's it's Ricardo.
Yeah.
Well, it was a team effort, and it is really a team effort to get something like that done. So our role was to kind of provide you with the guidance on, hey, what type of partners do you need to be able to do that? Because you came to us with, hey, here's an opportunity. I would love to be able to take this property down. And our role is, okay, how do we build that team for you? So that's where your KPs came in. And we did have some KPs on your team
Correct,
that had previous Fannie Mae experience.
That is correct.
So that was the key. It's being able to have the net worth, the liquidity, and then in this case, you had to have the Fannie Mae experience to get you over the finish line.
And that made all the difference. Absolutely. The KPs and the guidance. It was, again, the team.
So what did Mike give you originally so you could even quote the deal to make sure it even qualified for Fannie Mae?
Yeah, so a couple things we look at. We always want to see the trailing financials on the property. So a clean trailing 12 months of operating financials. A rent roll is kind of what we need to see. It's kind of step one is what we need to see for the property. So we need to get in, make sure the property underwrites well, that there's enough debt service coverage on the deal to cover the new debt. So that's step one.
Okay. So how long did it take you from the period of time that you gave him the quote to the time that you actually got the deal under contract? Was it a matter of weeks, 2 weeks? How long was this race that from the period of time you got engaged to the time they said, Mike, good news, here's the contract, please sign?
Honestly, it was pretty quick.
Very quick.
Really?
It really was. I was really surprised how quick and fluid everything went. It was a well-oiled machine. Probably within 2 weeks, everything was signed. The PSA was done.
Yeah.
And the scary part was it was $100,000 up front day one.
That was non-refundable?
Non-refundable. That was my scary part.
Yeah. What was good about that, though, too, is I happen to know the seller of that property, so that I think that was maybe a little bit of an advantage.
There's no doubt. No doubt.
I don't know about that, but that seller's a very good client of ours, and if he had run into any problems, he's a straightforward guy. He would definitely help you out and give you more time or whatever needed to be done. But he was a good seller. His numbers were good. You were keeping the same management company that he managed the asset with when he owned it, and you were just going to transition and use them. So I think that really was a help too, because that management company had his ear. And they also, not only were we helping you, but they were helping you and kind of giving him some feedback on how fast you were moving to give him a comfort level about what was going on.
I think you're right. And boy, Legends Asset Management really, they made the difference in the smoothness of this entire transition. They've been around for a long time. Like you say, they knew the asset. And boy, early on, they engaged with me and look, we went with them because they're good and they made it smooth.
Yeah, so that's maybe another little tell or a quick comment is that if you can talk to or at least use the management company that currently the seller is using that sometimes can help you make you or break you with the seller to go with you. Would you agree with that, Ricardo?
Definitely makes it a much smoother transition. In this case, did you keep the actual property manager?
I did.
You did.
Yeah.
So the same property manager, same property management company.
Everything.
And they were, like you said, engaged throughout the process because they knew that they're not leaving once this thing is done.
Yeah.
They're taking over. They're going to be managing the ship and running the day-to-day. So that was huge.
Yeah, because that's always a problem with a transition like this from the seller to the buyer is that the seller, lets the management company know that they will be ending their relationship within 45 to 60 days. And all of a sudden the manager, the maintenance person, the porter, all of a sudden find other jobs before we close. Yeah. Then all of a sudden, we're up having a problem, that occupancy's off and things are off. And then that's the most critical time is when the deal is going through closing. We got to keep all the numbers the same. So I'm glad that transition happened. Okay. So anything more on the loan itself?
Another unique aspect, we did go through and do the green program on the loan. So that was a big help. We went through.
What is that all about? What's that green program?
Yeah, so Fannie Mae has got right now a green incentive structure. So where they'll go in and do an additional inspection on the property, and they'll inspect it and basically give you an overview. Hey, where are the energy saving opportunities across the site? So they do the inspection, and then they'll give you a menu of, hey, here's where we think there are opportunities for you to save from an energy perspective, and they'll incent you to go in and make those updates or changes. I think in this case, we ended up getting about 22 basis point drop in the rate, which was huge.
Yep.
And talk through kind of what you had to do. It was pretty minimal, wasn't it?
So it surprisingly was. A lot of the incandescent lights were changing out to LED, and we're new at this. I mean, we're just now 3 months into this, so we're getting all our bids. But the overall process is going to be changing out the inside and outside LED or incandescent to LED lights, and one of the big focuses was water conservation.
Yes.
Even though we rub it, they're looking at the overall property as in energy savings and water conservation. So the big focus for us is going to be changing out the shower heads. They really didn't look at the toilets too much, but overall water conservation is what they're looking for. Yeah. And we have a couple plans for that.
And these were all items that you were going to do anyway.
We were going to do anyway.
Yeah, you were going to do them anyway.
We were going to capitalize it, yeah.
So now you just get a benefit, 22 basis point benefit to do it.
Yep.
And talk to them about how much it cost for the report. So there was an upfront cost. I think it was about $7,000.
It was $7,000 for the upfront report, and it is well worth it just for the report. It's very thorough, but they really point out a lot of stuff for you.
But you get it back.
You get it back.
At closing.
Yes.
Right. So as long as there's an upfront cost to do the report. Yep. Again, depending on the size of the asset, it's $6,000 to $8,000 is kind of average. But as long as you sign up and you meet their requirements, then you get it back at closing. So it's a win-win.
It is.
Very much a win-win.
It's a great program. If you can get it, it's a great program to have.
So you've owned it for a few months now. Let's talk about the takeover. Anything interesting that's happened over the last few months since you've taken it over?
Yeah, overall, the transition has been very smooth. Like I say, luckily we have a great management company, but we had a little glitch.
What kind of glitch?
We had an arson fire right at, about 2 weeks ago. Somebody decided to try and burn down a new pergola. And the fire department came out real quick and put it out, luckily. Mm-hmm. And we're lucky because it was a new pergola and it was green wood. But then half hour later, the fire department got called out again, and our laundry and office were on fire.
Wow.
So somebody had poured gasoline in a couple of the washers and then lit it on fire, and vapor gas explodes. It blew out all four walls. And luckily nobody was hurt, but it blew the guy out of his bed upstairs.
Wow. So he wasn't hurt, but you had hopefully insurance?
We had very good insurance. They have been great to work with. We have Strata, and very pleased with them. They've done everything. They've gone and sent their appraisers, sent their structural engineers, and so far everything is going great with the insurance company. We're very happy with it.
But it didn't burn the place down.
It didn't burn the place down because it was more of an explosion than a burn.
I see.
Because, again, gas vapor explodes. It just flashed and blew out all four walls. blew the brick wall down the outside of the building.
Have you met with the city yet? Or
Yeah, the city was out there pretty quick.
So
Yeah.
are you going to have to rebuild it to what it was back
No,
then? Or is it going to have to be up to new code?
Yeah, luckily, great clarification there. Luckily, it was only 2 units, the laundry and the office, that were affected. So I believe it's anything more than 40 or 50%. If more than 40 or 50% burned down, then you have to scrap everything and bring everything up to code.
Yeah.
Luckily, we were only about 25%.
Yeah. So a lot of these buildings may only have 8 units per building, or they may have 24 units per building, or they may have 6 units per building. So they kind of are all isolated like islands. And so the reason why I bring that up is it's, God forbid you do have a fire on the property. Usually only is an isolated fire. And I just came from a property in that same general area today that had a fire that took the whole building down. So it had 8 units that got crushed in the fire. But there was a steel fence around it, so it must have just happened recently because I saw beds outside, but the whole thing collapsed. So when he rebuilds it with insurance money, he's got to bring it up to code for the entire the entire building with fire suppression systems, hardwire, fire alarms, smoke detectors, and all kinds of stuff on that building. So they got to bring it up to the standards of 2016, 17. So that is going to be a lot more costly when the whole building collapses versus having 1 or 2 units that are impacted by fire or smoke or water damage. You got to bring it back to like 1980s standard. So, which can be a lot cheaper in a fire. But thank God nobody was hurt.
Agreed.
Having the right insurance is critical.
It really is. And thank goodness, being a Fannie Mae loan,
they require.
They really scrutinize it. And looking back on it now, you're questioning why you're scrutinizing it so much. And now that we had an incident, we're very thankful.
So you got 2 down units? Are those units down? Or?
2, they are down.
You're full. So what are you doing with the tenants?
Well, we were able to. It was kind of a transitional point. We actually had 2 people move out.
Okay.
Just right before that, and then we had 1 unit already in rehab. So when this happened, we were able to put the 2 people or the 2 families that were in the building. We were able to put them in rehabbed units. And then the 3rd one, we're now using it as a temporary office. So good, bad, indifferent, we're 100%. We're down 2 units and 1 being used as an office.
Okay.
But again, great insurance. We'll get
day in the life of a multifamily owner, right?
Agreed.
So have you started to do some of your rehab on the property?
No, we're not finished with the insurance claims yet. We should be getting actually all the information back this week.
And how about for the loan? When you guys bought the property, you guys were going to do some upgrades to the property too?
We did. They held back about $350,000 for all the rehab, and we're in the process of going through that.
Okay.
It's primarily interior upgrades, right? Interior upgrades, and then you said there was some the fencing,
the driveway, the lighting.
Yep.
But other than that, it's interior. Now, the problem with that is we're 100% full.
Yeah, it's hard to start swinging hammers when someone's actually occupying the property, and you run into just execution problems trying to get all this stuff done. So we heard the fire. Any other funny stories that comes with this property?
Wow, I wish I had some good stories. It's been so smooth, front to back. Yeah.
If you don't have any stories now, I'm going to say wait 6 months.
Yeah, you caught me on month 3, so we only had 1 good one.
Well, I really wanted to have you come over and talk a little bit in the podcast, just because you just took the deal over, and we're all friends here, and I wanted to make sure that in the front side of these deals, we'll probably talk here in about a year or so back in the podcast. Just kind of talk a little bit about what it was like at the beginning, and what it's going to be like a year from now. So maybe compare and contrast at that period of time. So what is your next step? Are you going to be looking for another property here in the next 6 months, or
we'll probably start looking pretty quick.
Yeah, this property's already stabilized.
It's stabilized. It's a great property, great location, stabilized. Like I say again, the great management company, they make my life easy. So honestly, I'm ready to start looking for the next property.
Yeah, and that's one of the biggest things is, I want you as an asset manager not to really manage the asset. I want you to go out and find another property put the whole team together again. Let's put the band back together again. And raise the money, and then be responsible to your partners about what's going on.
Yep.
So you just kind of stamp. Just keep doing it over and over and over again, and that's how you start to make money in this business. Then try to think about buying a 25-unit apartment building and trying to buy yourself a second job by doing that. That doesn't make any sense.
No, nothing but headaches. That's why I say
these larger properties are easier to manage.
Yes, they are.
If you don't have a management company, you are the manager on these deals, and so you can only push your expenses over so many minimum units. It just becomes a lot easier when it's 70, 80, 90, 120 units or greater. You can start be flexible how much you can pay for staff, and you can get better staff with larger units that you control and manage. Anything more to add to that?
No. Makes a lot of sense. I mean, we look forward to hearing about what's coming next and bigger and better for Mike Spotts. You want to give contact information on people want to reach out? Contact
sure.
you?
What's
absolutely. The best way to reach you?
Email's usually the best. Absolutely. My email address is mspotts, SPOTTS, at greystoneprop, GREYSTONE, PROP as in property.com.
Michael Spotts, thanks for hanging out with us. I always enjoy talking with you. You're always optimistic. I love it. So I wish you a lot of luck on this property. You're a hard worker, and it's going to be a great opportunity for you and your investors. And I can't wait to see the next property that you buy. Thank you, Ricardo Hinojosa, for sitting in the podcast.
Great to be here.
Paul and Ricardo, thank you for having me. I appreciate it.
Ricardo does a great job. Again, if you want to try to figure out how we structure these apartment transactions, make sure you send an email or go to the oldcapitalpodcast.com website. On the Old Capital Podcast, you'll have the opportunity to get a 15-page white paper due diligence report, and you want to go through that and kind of understand how we structure these loans. So also, if you have a chance to go to iTunes and put a 5-star rating with maybe a couple comments if you like the podcast. We hope you do. If you like the podcast, if you can fill out a 5-star report, we appreciate that. Again, for Michael Spotts, Ricardo Hinojosa, Paul Peebles, thanks for listening.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.